Hello and welcome to the BDO Not-for-Profit Accounting Standards update for 31 December. Sincere apologies for the late start. I'm sure you've all heard this a million times, but technology held us up here, so very sorry about that. But we'll certainly jump straight into it because we've got a lot of really interesting content to work through. So I would like to start by acknowledging the traditional owners of this land and paying our respects to elders past and present. Okay, so we'll just go through and introduce today's presenters. So my name's Anthony Whyte. I'm an audit partner in the Brisbane office, and I lead our not-for-profit service offering. Aletta Boshoff will be providing the IFRS update today and is our national leader in the IFRS corporate reporting and quite interestingly the ESG and sustainability as well. And I can say that with the audit committee meetings that I've attended in the last 3 or 4 months, there's consistently questions coming up in that space from my not-for-profit clients. So it'll be interesting with what Aletta has to talk about with that. The other panelists that we have today that will present briefly on topics once we finish the IFRS update. We have Stefanie Merlino from the Melbourne office. Stefanie is a partner in the people and advisory team and has some really interesting points to go through around superannuation, consultants versus employees and portable long service leave. Russell Postle, who is a consultant in the Brisbane office in the business services area and for a very long time, and I don't mean that in a nasty way, Russell, for a very long time a partner within the tax and business services area and heavily involved in not-for-profit. And he'll just quickly go through some tax reporting that interestingly in our view will affect all not-for-profits, regardless of whether you're a charity or not. And then finally, Fahim Khondaker, who is a partner in our data analytics consulting space, and presented actually a week or two ago now to a number of not-for-profits in Brisbane around data analytics. So there was a lot of interest in that shown by the participants. So we thought we'd just provide a brief overview around the data analytics piece. So I think we've certainly got a lot of interesting content there to get through in the next hour and a half. So I think you should be able to post questions as we go within the presentation. So certainly please post your questions. I'm not exactly sure that we will have enough time to respond to those at the end, but where possible, we will try to go back to you directly, and it'll certainly help inform us around further, I suppose, thought leadership that we put up on our website and whatnot, if we do have your questions. So I'll hand over to yourself, Aletta, to go through the IFRS update.
Thank you very much, Anthony, and good day, everybody. Lovely to see all the fellow partners. Fahim, I'm actually, as Anthony did the introduction, I thought, you know, I've got 4 children and the 4th one was thinking about becoming a chartered accountant. And now I've also lost her to data analytics. So I'm thinking, really, do I have to listen to Fahim and data analytics again today after I've just lost my daughter to data analytics? I thought at least one of them will come and work as an accountant, but very excited to hear all the things you have to say. My daughter also tells me, Mum, all the power in all this data. So today, talking about everything that's important to not-for-profits at the moment, and starting with IFRS and also sustainability reporting, I thought I would flag up front that BDO in Australia have last week, on the 31st of October, we've published our second sustainability report, the 2023 sustainability report. We look at World Economic Forum, IBC, and we've disclosed what we've done in the last financial year around people, planet, prosperity, and principles of governance. And you can see there's a link right at the bottom in blue to the actual report. We're very proud of this report. In particular, this year, we've included our carbon footprint, Scope 1, Scope 2, and Scope 3. Now, we've used FY22 as our baseline for BDO globally. However, we couldn't get it all done to include in our inaugural sustainability report in 2022, but this year we've got the 22 carbon footprint as well as the 23 carbon footprint in there. So it will give you a little bit of an idea what we mean by all of that. So I thought I'll flag that the report is available, and we hope you enjoy that. Obviously, it's important to us. It's important to our partners and our staff, our stakeholders, and very important also for our clients. So you can have a look at that. Now, on IFRS and corporate reporting and also sustainability, my two worlds are colliding, Anthony. You know, where IFRS and financial statements used to sit quite separate to sustainability and sustainability reporting, there's a great deal of overlap these days. So when I talk about that today, I thought I'll only put 3 items on the agenda. And that is, let's talk about sustainability reporting, because the partners have been telling me, all the audit partners, whether it's for-profits, not-for-profits, that's what boards and audit and risk committees want to talk about at the moment. So a lot of questions around sustainability reporting. And I'll also say up front, if your board or your audit and risk committee or your executives would be interested in a bit of an update in the lay of the land, we have monthly webinars, but also I'm doing a lot of presentations. Sometimes for a board, it's just 15 to 20 minutes to give them the latest information. So please reach out, happy to do that. The second item I've put in is something that is often problematic, and that is the classification of liabilities, particularly loans as being current or non-current. And there's been changes to IAS 1 or AASB 101 that's becoming effective within the next year. So I would like to flag that. And then finally, what is particularly new for not-for-profits? So you'll see we've done a similar webinar in May this year or June this year. We've talked through a lot of changes. I'm not repeating that. That webinar is available on our website. So I thought let's just focus on 3 key items: sustainability reporting, changes to the classification of liability, and a few new developments. So let's start with sustainability, absolutely the topic of the moment. So maybe a bit of a step back, just a reminder that when we talk about sustainability, when we talk about ESG, it's a whole raft of items. There's environmental factors, there's social factors, there's governance factors. And you can see here that climate change or carbon footprint or emissions is only one aspect within the environment. There's a lot of other items that entities could focus on. And we always say it's really important that you engage with your stakeholders to assess what's important to them, overlay what's important to you, what you can impact, and then decide on reporting. Now, the one item that you cannot exclude at this stage is climate change and therefore the calculating your carbon footprint and disclosing your carbon footprint. And that's a non-negotiable. It's becoming mandatory reporting in Australia, mainly for for-profits, but also for some not-for-profits, but it will also be important in order to keep clients. So basically, that one environmental aspect is a no, it's not negotiable, but all the others, depending on your stakeholders, depending on your business. So what is the real business problem and opportunity here? It's all about access. In order to have access to capital, so if you are raising funds, if you're looking at government grants, if you're looking at donations, any kind of capital support, fundraising, You know, the interest is what are you doing around sustainability? What are you doing around ESG? And often, what are you doing around carbon and reducing carbon and setting targets? So access to capital, extremely important, including for not-for-profits. Then access to markets. So in order to continue to provide goods and services to your markets and to customers, again, a focus on what are you doing around carbon, but also the other ESG factors, and access to people. A lot of people only want to work for organizations that have been aligned to these factors, sustainability measures, and are taking climate change seriously and looking after people, etc. So I think that the best way to explain the business problem and opportunity is about access to capital, markets, and people. And I think that access to capital is particularly important for not-for-profits.
Sorry, Aletta, I'll just support that with what I'm seeing, and that's exactly right. So it's whether the government in providing grants and where there's significant grants are certainly looking at that, and within the for-profit sector, and organisations to need to report under this. I see that boards are recognising this because they're mentioning it themselves, that through their own organisations reporting, there might be for-profit entities that want to work with them to help meet their requirements. So it certainly is that access element that you're talking about.
Absolutely, Anthony. We had a roundtable lunch in Melbourne with a number of not-for-profit, and you know, a lot of people attended, and we weren't sure what they want to talk about. And in the end, the key thing was around sustainability reporting and how it impacts those access elements, actually. So incredibly important. So let's fast forward that. So there's all these sustainability factors. We know it's an access game. And so the next thing is, how do we respond to that? How do we ensure we continue to have access to the capital, to the markets, to the people? And the way to do it is to report, to communicate, to let people know what you're doing. And when we talk about sustainability reporting, it's incredibly important that we differentiate between voluntary reporting in a separate sustainability report, the blue bits on the screen, and mandatory reporting in the annual report. So there's a few reasons for that. If you look at that separate sustainability report, and I've shown you, or I've given you a link to BDO Australia's separate sustainability report. It's voluntary to prepare. There's more than 500 frameworks. You can pick a framework, or you don't even have to pick a framework. You can just pick themes. So there's a lot of, you decide what you want to report. It's all voluntary, as the fact that you're doing it is voluntary, what you put in there is voluntary, and often not a lot of, and no requirement for assurance, right? So it's all voluntary, and it's looking at all those aspects, and you do a stakeholder assessment. When we go to the right-hand side and we look at mandatory reporting in the annual report, as you all know, you put information in an annual report, it's a different level of scrutiny. It's a different level of requirements around credible information, and often it would assurance would be required. So we're talking about mandatory reporting being the game changer in Australia at the moment, and it's what everybody's talking about. So on the next slide, I'll also show the link between the two. So mandatory reporting at the moment in Australia, the only thing we have that is, I would say, as close as we can come to mandatory is the TCFD recommendations, which is strongly encouraged by the ASX, ASIC, and other regulators. But very soon that will be overtaken by IFRS S2, which is climate-related disclosures, and a year later IFRS S1, which are the general sustainability disclosures. Now you might say, looking at these two, why is it so important to have them separate? I think this diagram links the two really well. So where we have in the bottom left-hand corner financial statements prepared in accordance with Australian accounting standards or IFRS being audited by Anthony and alike, those financial statements will now be mandatorily be supplemented with sustainability-related disclosures. That's the light blue or the aqua bit. Together, those will be your general purpose reporting, your annual report, and there'll be assurance over those. And the grey bit you see right on the outside is your separate voluntary sustainability report, using frameworks like GRI, World Economic Forum, etc. And what we are expecting to happen over the next number of years is that this aqua bit or the light blue bit will become bigger and bigger and bigger, and the grey bit will become smaller. And eventually, all this information that's material to your business will sit in the annual report. So we will see an IFRS S3, S4, S5, S6. So your mandatory reporting is expanding, and the voluntary reporting is contracting or is actually moving over to the mandatory annual report. And that's a big issue because all the freedom in this separate voluntary report are being replaced by mandatory information in an annual report subject to assurance. It's a big shift. So a little bit of background since our previous webinar on Monday, the 26th of June, the International Sustainability Standards Board, which is a sibling to the International Accounting Standards Board, issued their very first two standards, IFRS S1, General Requirements, and IFRS S2, Climate-Related Disclosures. And then on the next day, the Australian government came out with their second consultation paper. Now, this consultation has really, second consultation paper has created a somewhat of chaos. It's provided clarity and chaos all at the same time, because the first consultation paper in December 2022 indicated that mandatory sustainability reporting in the annual report will be aimed at listeds only. And this consultation paper said, no, forget about that. The focus is on the size of the organization. So if you're a large organization, whether you're family-owned, private, listed, doesn't matter, you will be captured by mandatory sustainability reporting. We are waiting for the final document, and Treasury is set to release that imminently. But the word around town is they're not changing that much. So we're looking at the proposals in this second consultation paper. Interesting for not-for-profits, though, is they haven't addressed public sector in the consultation paper. They've just said Minister of Finance is looking at it. For not-for-profits, if not-for-profits are preparing and lodging financials with the ACNC, the mandatory sustainability reporting in this consultation paper wouldn't impact them yet directly. However, if not-for-profits are of a certain size preparing and lodging financials with ASIC, it would apply to them. However, we should always think on the broader consequences. So maybe mandatory sustainability reporting doesn't apply to a not-for-profit directly yet, but if you're in that supply chain, if you want to get that access to the capital, access to markets, it is still a game changer for those not-for-profits as well. And then 2 weeks ago, the Australian Accounting Standards Board, interesting, globally, we've got International Accounting Standards Board, a sibling, International Sustainability Standards Board. In Australia, we have only one standard setting body. The Australian Accounting Standards Board will be issuing accounting standards and sustainability standards. And the AASB have issued 2 weeks ago an exposure draft where they are dealing with IFRS S1 and IFRS S2, all in the same exposure draft, as well as a reference standard, which is just putting it together. So that's not the key focus. Comments are due by Friday, the 1st of March, 2024. They have to finalize the actual standard in Australia very fast, because if we look at the mandatory reporting timelines globally and which they support in Australia, that will be 31 December 2024. So these consultations are out. Now, that Treasury consultation paper, I've talked about the following, and I thought I'll give you a little bit of an overview. if you're in group 1, and BDO in Australia is in group 1, and therefore we have to do a lot of work in this space already. If you meet 2 of the following criteria, you group 1. So more than 500 employees, gross assets of 1 billion or more, consolidated revenue of 500 million or more. You meet 2 of the 3, you group 1, and mandatory reporting is effective for 2024-2025, which means if you've got a 31 December year end, it's 31 December 24. And if you've got a June year end, it's 30 June 2025. And then group 2 is 2 of the 3 thresholds again. And then group 3 are the entities currently preparing and lodging financial statements with ASIC. So it's going to go to all general purpose financial statements. And you can see group 2 has an additional 2 years to prepare, and group 3 an additional year after that. However, our prediction and what we're already seeing in the market, because group 1 has to do mandatory reporting, has to set targets, they cannot do it without their suppliers. Therefore, a lot of small and medium-sized entities, in addition to groups 2 and 3, are already captured and impacted now. And then at the bottom, I've given you some idea. We're starting with climate disclosure, IFRS S2, scopes 1 and 2, and then the next year, scope 3, and as well as IFRS S1. Maybe to bring it back to smaller businesses, including smaller not-for-profits. If an Australian entity need to report and set targets to reduce their carbon footprint, which we know is the case, and it's more and more happening, if you look at your carbon footprint, we do a lot of work in this space. You look at your carbon footprint. Scope 1 is the bit under the control of the entity, so it's emissions under your control, usually at your premises or lease premises. Scope 2 is purchased electricity, and somewhat you've got control of what you buy, the efficiency, whether you buy renewable, right? But when we get to scope 3 are indirect emissions, where you buy goods and services from your suppliers. And there are emissions embedded in all those goods and services before they arrive at your premises and at your business. And we know that scope 3 make up 80 to 90% of most entities' emissions. Therefore, if organizations have to report and reduce their emissions, they cannot achieve their targets without reducing scope 3, because that's the biggest part of their emissions. And therefore, they will push, and we're helping clients to do that. They will push into their supply chain and everybody they do business with and say, how are you measuring your carbon footprint? Can you provide it to us on an annual basis? I actually have clients who have to provide their carbon footprint to their key investors on a quarterly basis. Those investors are super funds, for example, but there's pressure to report. First of all, then there's pressure to set targets. Then there is pressure to report against the targets. And then there's a need to have assurance over whatever you report. And we are seeing that there might be some pressure on the selection of suppliers and where we allocate our funds and who we lease our properties from based on targets and emissions. So this is really the important thing for not-for-profits and smaller business, how it flows through the economy. So what does it mean for you as a not-for-profit? I think it's incredibly important that you understand how you fit into the economic system. And really what I mean by that is, if you look at your business, who is giving you capital? Who are your customers? Who are the people who work there? So who are your key stakeholders? And what pressures are they under to measure a carbon footprint and to provide this information? So what information will they demand from you, and would you be ready to do that? And, you know, I think the big thing, Anthony, a few months ago, I've written an article that got a bit of media attention because I used the phrase, you can hide, but you cannot run, when it comes to sustainability and in particular, measuring your carbon footprint. So it's about getting started. I'm an academic at heart, as many of you would know, and therefore I think part of getting started is engaging with your stakeholders and education of your stakeholders, taking them on that journey, slowly. And if you want assistance there, please reach out. We would love to help you. Talking about carbon footprint, by the way, I think many of you are familiar with accounting standards, and you are becoming familiar with sustainability reporting standards. But there's another set of standards that we have to get our head around, and that is the greenhouse gas protocol, because the greenhouse gas protocol determines globally how a carbon footprint is measured. And it, again, quite extensive literature. And for me, this has actually been, I love learning, so it's been a great amount of fun to get my head around this over the last number of years, and to be able to, I've done courses, etc., and to implement this at clients, because it doesn't really matter which standard you use for reporting in the voluntary report and the mandatory report. The actual measurement of your carbon footprint is always in the greenhouse gas protocol. So they have a globally accepted protocol. So again, currently we're running, Dylan Byrne and I are running a series of webinars where we step through the greenhouse gas protocol. So it's 6 webinars. We do what we can in 6 hours. There's a lot more to cover. But if you're interested, you can look at the recordings or join the live ones. Also, if you look at reporting, there's a TCFD checklist that BDO has prepared to get you going. It's a really good stepping stone that you could already use now to get you ready for IFRS S2. And then I just wanted to flag that around sustainability at BDO, I mean, we are accountants, we are auditors. For us, we've come up with our core services. So we help clients with carbon footprint measurement. And we also have strategy people who help with decarbonization strategy. We help with sustainability reporting, whether it's in the voluntary report or the annual report. We help with sustainability strategy, how to activate, how to get started, develop a roadmap. And then our whole assurance division, Anthony and all the audit partners, can provide assurance over carbon footprint, over sustainability reporting. So these are the key offerings that we already have, and I've got a slide to explain it a little bit more. So please feel free to reach out to us if that's of interest.
Aletta, just before you, sorry to interrupt, just before we move on to the next bit, I imagine a lot of people listening to this would have found that really interesting, and just knowing with the discussions at audit committee and board and the questions that are being asked like that, that would have been really interesting for those people. I think for a lot of not-for-profit organisations, it is understanding, well, how does this impact them? And I think you've done really well there in putting it in context. And then it is, where do we start? And I really like what you mentioned about talking to your stakeholders, like talking to the government department where a lot of your funding comes from, and understand with them what's their expectations going forward. How do they see this impacting them, and what importance are they placing on this? And then maybe, and I think you might have touched on it and come through in those checklists, it is getting a handle on where the emissions from your business are predominantly coming from. And you highlighted the type 3 bit, and I'd imagine those that are providing housing for the homeless and whatnot, there'd be some significant areas there for them to think about. I thought that was really good, Aletta.
No, thank you, Anthony. And again, an open invitation. We're doing a lot of these presentations to boards and executives, and would love to get involved. So please let us know. And we're doing it as part of that awareness and education. So let's come back to accounting standards. After all the exciting sustainability reporting, Anthony, a little bit of accounting standards. The biggest change in the world of accounting standards at the moment is this classification of liabilities. And then over the next year or 18 months, we're actually expecting IFRS 18. And that one will be replacing IAS 1, looking at the presentation of financial statements. and they're going to change the structure of presentations of financial statements a bit, but it's too early to look at that. We'll wait for IFRS 18. I think the important one at the moment is the classification of liabilities. There's been two parts to the changes. There were changes announced in 2020, absolute uproar across the world, a lot of comment letters, a lot of easy fits, and then the IASB had another exposure draft, and 2022, there were final changes. So in Australia, I want to warn you, it's a little bit difficult to read the standard because it's not been compiled yet. So you have to look at the original one and then one set of changes and another set of changes. Really, really difficult. So if you want to get to all the changes in one spot, we've got a publication you can look at, but you can also look at IAS1. The international standard is actually already been compiled. So I'll just give you a warning about that. Then if you look at the application date in Australia, the first time it will be applicable for 31 December year ends will be 31 December next year. However, you'll have to do a comparative restatement for 31 December 2023. And your opening balance sheet will be 1 January 2023. So I thought it is important to already talk about this because there will be that comparative restatement. It won't be just prospectively. So that's just application dates. Now, the standard and the changes deal with four things. The first one is the right to defer settlement will no longer have to be unconditional. However, that right to defer settlement have to exist at the end of the reporting period. So at 31 December, we need to have the right to defer settlement. The good news, it doesn't have to be unconditional, and I'll show you some examples. The second one is that right to defer settlement is the focus, so it's not your intention. So maybe you have the right to defer settlement, but you've got the intention to settle it within the next 6 months. In the past, we might have said in that situation, it's a current liability. The standard says, no, we're looking at rights. It's the right to defer settlement, irrespective of what your intention is. It's aligned with what we these days see in a lot of accounting standards, IFRS 15, 16, 9, it's about your rights. The third one, if you've got convertible notes or bonds, which I don't expect in not-for-profits, there are new rules there. And then finally, there's some additional disclosures. So I'm going to focus on the first two, which I think is more applicable to not-for-profits. However, I've included in here a link to a presentation that I've done in 30 June this year, looking at all four of these aspects. I know some of our attendees of the not-for-profit webinars are also board members at for-profit entities, and therefore they might be interested in that, so I've included that link. So there are two big changes here around that right to defer settlement. So they've included a new paragraph 72 capital B. And this one now clarifies how covenants in loan arrangements would affect an entity's right to defer settlement for at least 12 months after the reporting period. And there's two parts to it. They first of all say, and this is the yellow part, you must comply with the covenant before reporting date. And if you comply, and that requirement to comply with the covenant before reporting date would affect your right to defer settlement at reporting date. So if you're in breach before reporting date, you've got a problem. If you are meeting the covenant at reporting date, all good. Interestingly, if compliance is assessed after reporting date because you assess it based on audited numbers and you have to wait for audited financial statements, that is still okay. The fact that for practical purposes we have to wait for the final numbers, that is fine. If you go to the blue bit, they also say you must comply with the covenant. If it says you have to comply with a covenant, and it will be assessed in 6 months' time, so let's say at 30 June, that fact that you have to continue to comply with that covenant in 6 months' time does not impact your right to defer settlement at reporting date. So it's absolutely looking at reporting date. Do we meet the covenant or not? Do we have the right to defer at reporting date? So this is an important one. The other change that they've made, so the one is they've added paragraph 72 capital B. The other change is they've made some changes to paragraphs 74 and 75. And I've grouped them together because a big part of your assessment will be, are we within paragraph 72B or are we within paragraphs 74 and 75? That's your initial assessment, and that will drive your answer in a big way. So what they say in paragraph 74 is when an entity breaches a covenant condition for a long-term loan arrangement on or before the end of the reporting period, with the effect that that liability is now payable on demand, you would classify that liability as current. Even if the lender agreed after the reporting period and before you finalize your financials for issue, not to demand repayment as a consequence of the breach, so it will be a current liability in that situation. So you've breached your covenant, it's a current liability. Then paragraph 75, however, an entity classifies that liability as non-current if the lender agreed by the end of the reporting period to provide a period of grace. So the concept of a period of grace, ending at least 12 months after the reporting period. So you were in breach, but the lender said before the end of the reporting period, we'll give you a period of grace, and that period of grace is actually for 12 months, 12 months after the reporting period. So not a period of grace for 3 months or 6 months, a period of grace for 12 months. All right, so you might say, Aletta, how does all of this interact? Let me give you some examples. So the first example is we've got an anticipated covenant violation. So entity A has a bank loan. It's scheduled to be repaid on the 31st of December, year 5. Entity A must comply with a working capital covenant at each calendar year end, so 31 December. If entity A fails to meet the covenant, the bank has the right to demand immediate repayment of the loan. And in early December, year 3, in anticipation of a covenant breach at 31 December, year 3, entity A and a bank agree the following. The covenant test will be waived, so we won't test it at 31 December, year 3. They've inserted a new covenant. So entity A is to test the working capital ratio at 30 June, year 4. So that's in 6 months' time. And if entity A fails to meet that covenant test at 30 June, year 4, the bank will have a right to demand immediate repayment of the loan. So there's two things happening here. You have to be quite clear. The covenant test at 31 December, year 3 will be waived, not testing it at all. It will have no impact. So the next time we'll test it will be 31 December, year 4. But we also include another covenant. There's a new covenant. So two things happening. So if you look at the classification at 31 December, year 3, do we have is it paragraph 72B or is it paragraph 74 to 75? So first of all, that covenant test that's been waived by the bank prior to 31 December, year 3, entity A is therefore not in breach of that covenant at 31 December, year 3, and therefore paragraph 74 to 75 do not apply. 74, 75 only apply if you're in breach, and before we test it, it's been waived. All right, that's what paragraph 75 says. The covenant test that's been inserted, the new one, is a future test. And remember, we've said it doesn't affect your right to defer settlement at 31 December. We don't look at future covenant tests. So we ignore that. So we would still classify this liability as a non-current liability. So two things are happening here. You have to make sure that that breach never happened because it was waived. and then we've inserted a new covenant which is in future and therefore again doesn't have an impact. So that's the one. So that's one example. Let's look at another example to contrast and compare. What about we have a violation and we have a period of grace? So entity A still has this bank loan repaid on 31 December. They have to comply with a working capital covenant at 30 September each year. And if entity A fails to meet that covenant at 30 September, the bank has the right to demand immediate repayment of the loan until the next covenant test on 30 September in 1 year's time, unless the bank agrees otherwise. Now, entity A actually breaches that loan covenant on 30 September. So they're in breach. And on 1 October, after they've breached their covenant, the bank agree not to recall the loan for 6 months. So until 31 March, year 4, we won't recall it. There's a new working capital requirement at the end of the 6 months period, 31 March, and the bank retains the right to recall the loan at the end of the 6-month period, the 31st of March, regardless of whether the working capital requirements are met at 31 March or not. So really, we won't recall the loan for 6 months. So it's been, let's say, the bank has given up that right, but not for a period of 12 months, for a period of 6 months. All right, so it's just one could call it some kind of period of grace for a 6-month period only. So if you look at the classification at 31 December year 3, the bank or the entity A breached the covenant at 30 September. As soon as you breach your covenant, you apply paragraphs 74 and 75. The bank only provided a period of grace for 6 months, and actually it's only 3 months after reporting date. Remember, we're looking for a period of grace for 12 months after reporting date in order to get to a non-current liability. Therefore, in this situation, paragraph 75 says this is a current liability. I know there is that future test at 31 March, but paragraph 74 and 75 will take precedence here because there's been a violation, there's been a breach. That future test will still run separately, but the fact of the matter is we've had a violation and we only have a period of grace for another 3 months after reporting date. But you can see this is a whole new world we're dealing with here. Another example, entity A has a bank loan, it's scheduled to be repaid 31 December year 5. Have to comply with it at 30 September each year. Entity A fails that covenant, and the bank has the right to demand immediate repayment of the loan until the next covenant test on 30 September in 1 year's time, unless the bank agrees otherwise. Now, entity A breaches the loan covenant on 30 September year 3, and on the 1st of October, the bank agrees. Remember, the 1st of October is still before reporting date. The bank agrees to legally waive its right to call the loan. A new working capital requirement is inserted for 31 March year 4. And then if the bank does not meet the covenant at 31 March, the bank will regain the right to demand immediate repayment. So on the 1st of October, the bank agrees to legally waive its right to call the loan. So now we've got an interesting situation, and it's still being debated quite hotly at the standard setter level. And that is, view 1 is this is a current liability. There's been a breach, paragraph 74, 75 applies. The borrower may be able to demand a repayment within 12 months. So end of story, it's a current liability, and BDO's tentative view is sitting there. However, many other people have view 2 where it's a non-current liability. So they say the lender gave up its rights with respect to that 30 September covenant breach. If you've given up your rights, effectively that breach has been cured. So we ignore it. And the borrower is in the same economic position as it's never had a breach. And therefore the future assessments, the new covenant and the future assessment 30 September year 4 are future assessments, and therefore we don't take it into account. I think a lot of the discussion around this view too has been exactly what have we waived, how long have we waived it, is it really a waiver? So, you know, it's a difficult position. I've put it out there that, you know, it's not been 100% clarified, and even the standard setters are discussing this further. So that's a tricky one and a difficult one, but we'll keep you informed through our newsletters. And then example 4, you know, if you've got a bank loan, it's scheduled to be paid on 30 September year 4. It may be rolled over for a further 3 years. If we meet a covenant at 30 September year 4, if entity fails to meet the covenant, there will be immediate repayment. Again, here we would say if an entity has the right to roll over an obligation for at least 12 months, it will classify it as a non-current liability, even if it would otherwise be due within a shorter period. So this is that focus on the right to roll. If you've got that right to roll in place, it will be non-current liability. There's a future test. Remember, we ignore future covenant tests. So again, this will now be a non-current liability. And then the last example I've got here is around a 2-step covenant test. You know, so maybe there's we repay the loan at 31 December. There's a minimum interest coverage covenant of 10 that we have to comply with at each calendar year. And if we fail to meet the covenant, the entity is required to place an amount of cash in a designated bank account opened with the bank. So there's a second step to it. And that amount of cash is required to be added to net income to make interest coverage of at least 10. And if the cash is not placed within 31 days, the bank can demand immediate repayment. So there's 2 steps. You breach your minimum interest coverage, then you have to put the cash in the bank account. And if you don't do that, again, we've got a problem. So you've got a covenant, which is that interest cover, and then you've got a potential remediation of the covenant, and that is the minimum cash deposit. So again, here, if it's breached at 31 December, because we don't meet the interest cover, and the remediation has not occurred at 31 December, then you have no right to defer settlement, and it's a current liability. There are some alternative views saying, listen, it's a non-current liability because you still have that opportunity to deposit the cash, let's say, till the end of January. But again, in our view, we would go with a current liability scenario. This is complex, it's complicated, it's very new. We've got a publication out on IS1 amendments that you could look at, and not to be confused. For 31 December this year, you still look at the current IS1 classification, and we also have a publication on that. But this is just to flag, as you enter into new loan arrangements, to be aware of the new rules that will come into play. So two publications, the amendments, but also the current classification. Then I'll quickly look at the new updates, Anthony. Believe it or not, I'm going to keep it in time today. If we look at the proposed Tier 3 reporting framework for smaller private sector not-for-profit entities, now this has been a big project by the Australian Accounting Standards Board. They've issued a discussion paper on the development of simplified accounting requirements for a potential new Tier 3 not-for-profit private sector entities, and comments were due by the 31st of March. Now, one of my team members here at BDO is on the project advisory panel looking at all these comment letters. Kerry Ann, based in our Sydney office, and they're still working through all these comment letters. I think what's important to understand here is when we look at AASB 1060, the simplified disclosures, it's only looking at simplified disclosures. So if you prepare general purpose financial statements Tier 1, it's all disclosures. If it's Tier 2, AASB 1060, it's simplified disclosures. But never ever have we in Australia ever played around with recognition and measurement if you prepare general purpose financial statements. So this project is somewhat groundbreaking because for a potential third tier of not-for-profit private sector entities, they are actually looking at going further than simplifying disclosures, but they're looking at simplifying accounting and measurement, so debits and credits and how you measure it. So I think it's important to understand, where that fits in. So you'll see there will always be on the right-hand side your Tier 1 full IFRS recognition measurement disclosure. The current Tier 2 for simplified disclosures will stay, but also there will be that Tier 3 simplified accounting. There's often confusion, so I want to touch on it again. There's often confusion. This general purpose Tier 1, Tier 2, Tier 3, and please note it's general purpose Tier 3, right? Simplified accounting, it's groundbreaking. That's not the same as what we have under the ACNC, large charity, medium charity, small charity. Small charities will still be preparing financial, special purpose, general purpose. They're not looking at that, at the real small charity. What they're thinking is that potentially your medium and large charities could potentially consider using Tier 3. And there might be a consideration by regulators to what extent would they like large charities to consider Tier 3. So the AASB is not deciding who can apply Tier 3. They're just making the rules, and it's for the regulators to decide whether they want charities or people who lodge with them to apply Tier 1, Tier 2, or Tier 3. And I think that's important. So some of the things they're thinking about, and remember, this is not final. Kerry Ann said, Aletta, you can't say anything is final. It's not final, so please take note, nothing is final. They're thinking of removing potentially for this Tier 3 that statement of changes in equity, and for the statement of cash flows, just use the direct method, no separate investing and financing cash flows. They're also looking at some new principles for fair value, and that potentially for unlisted share investments, the cost can be used as an approximation of fair value. We know it's somewhat problematic. And there's a lot of other areas. My favorite topic, leases. They're thinking of potentially making simpler rule for leases, so not right of use assets and lease liabilities and those beautiful things. Simpler rules around financial instruments. The one that's a real sticking point is the first one, consolidation. It's a real issue. Should these entities be required to consolidate entities that they control under IFRS 10? But you can see some of the changes. You can look at our corporate reporting insights every month. We try and give an update, and the AASB also release a media release every month after their meeting that provides an update. So if you're interested in that. And then finally, if you need any assistance around IFRS corporate reporting, we've got 6 partners looking at this across Australia. Clark sitting with Anthony in Brisbane, Clark Gerald, Etienne and I in Melbourne, Ashley in Perth, Kevin in Sydney, and Lynn Dow in Adelaide. And this is our broader team. In addition to the partners, we've got these amazing people who will help with IFRS and corporate reporting, also carbon accounting these days and sustainability reporting. You can register for our insights. You can register for webinars. So I've given you a few links there. Anthony, I think it's time to hand over to Stefanie.
I think so too, Aletta, and thank you very much for going through all of that. There was certainly a lot in that, and a lot of interesting material. And I think even from the borrowing point of view, even though I think only a handful of our clients in the not-for-profit area do have borrowings, a number of them have investments in entities that have borrowings, and I think it is important to understand where those changes are going. So I would like to hand over to Stefanie now, who I introduced earlier in the presentation. As mentioned, Stefanie has some quite interesting material around superannuation and consultants and portable long service leave to go through. So Stefanie, I'll hand over to you.
Thank you, Anthony. And Aletta, well done on wrapping up ahead of time. I'll begin. So I've got quite a bit to cover. I've got the next 15 or so minutes. So the first update that I'll be covering is around payday super. So superannuation is my first topic. Payday super is a change that was announced as part of the federal government's FY23-24 budget that was handed down earlier this year. Thank you, Aletta. Here we are. And payday super, so it's set to commence 1 July 2026. So for those who are familiar with the change, what it does is it requires employers to remit their super contributions on the same day that they pay their employees. So you can see at the table I have on the slide, that's how the super regime currently operates, and it's a quarterly obligation. Basically, employers have to contribute super every quarter. So you'll see that the due date for superannuation contributions under current law is 28 days after the end of the quarter. Under the payday super measure, you'll need to contribute super, as I mentioned, on the same day that you are paying your employees. So if you are a monthly payroll, you'll have to contribute super every month. If you're weekly, it's every week. And if you have a combination of pay runs, I know clients, some of my clients have weekly, fortnightly, and monthly pay runs, you'll have to contribute super every pay run. So it can become there's a lot more compliance under these new changes. What is payday super actually aiming to achieve? So it seeks to address SG non-compliance by giving employers, the ATO and employees more oversight over superannuation contributions. There'll be benefits for the employee. The employees are getting their contributions sooner, so basically increased investment income by having those contributions in the fund sooner. And the ATO will be able to address target any non-compliance by having information real time. There was a consultation process that closed on Friday, so the 3rd of November. BDO welcomed the opportunity to participate in that, so we did make a submission. That consultation process was quite a large process. There were 49 questions that were raised as part of the consultation paper, as it basically requires a full redesign of the superannuation regime. So there's no legislation on this yet. I suspect that after that consultation process has been completed, Treasury will have a better idea as to how this new change will be implemented, and we'll start to see legislation being drafted at that stage. So if we move on to the next slide. So there are a number of changes as a result of payday super. Firstly, for employers, super contributions will need to be integrated with the regular payroll cycle. As I mentioned, when you pay your employees, you'll have to remit those contributions into the fund. Now, there will be some challenges to this. For example, employers will need timely and accurate access to superannuation fund details. So if you think about choice of super obligations that employers have for their employees, an employer has 28 days to get that choice of super fund information completed. Under payday super, you'll need to know an employee's super fund straight away so that you can then comply with those obligations. There'll also be significant changes for the payroll system. An employer will need to correctly calculate their superannuation in real time. So you can see on the slide some aspects that will require some updates. If you think about the maximum super contributions base, so for those employees who are higher income earners and earning above the maximum super contributions base, which for 2023-24 is currently $62,270 per quarter, that will also require amendment, because if you're paying employees every pay run, it's going to become a lot more difficult to apply those caps. So that's part of the consultation process as well. Now, if we move to the superannuation guarantee charge impact that these changes will bring. At the moment, under current legislation, the SGC applies equally to employees who make contributions 1 day late, compared to those who may not, who completely disregard the law and don't make contributions at all. So at the moment, there's a need to complete the very administrative and cumbersome SGC statement process for every quarter for every employee where there's non-compliance, and there's limited scope to correct any small administrative errors within the SGC framework. So under this payday super change, we expect this to also change significantly. And what Treasury is seeking is a deterrence to employers to basically, they want to deter them from not complying. They're wanting to simplify the regime, but there also needs to be some kind of distinction between those employers who are seeking to comply with their obligations, but for some, maybe there's some complexities in their certain pay code systems, which are leading to some configuration error. So those types of scenarios shouldn't be penalised in the same way as employers who are not making contributions at all. Now, the SGC regime does have a penalty regime where penalties can apply that are up to 200% of the SG shortfall. This will also be reviewed as part of this payday super change and redesign. Moving on to the next slide. As part of the consultation process, as I mentioned, the government is seeking input about the policy and legislative design of the super regime. Some of the questions that were posed, and as I mentioned, quite a detailed process, there were 49 questions. One of them was whether payday should be the date that the contribution is paid by the employer or received by the fund. Now that's a really important one because many employers will make their contributions via a clearinghouse. So if it's the latter, being payday, the date that contributions are received, then those contributions will need to be made to the clearinghouse before payday so that they're received in time. So we'll be keen to see where that one lands. Another area that's part of that consultation process is whether there should be a grace period for employers to self-correct errors. So before there's any penalty imposed, the ability to fix things up without having to bear the brunt of any penalties. And also the appropriateness of the current compliance regime around the SGC, deductibility of SGCs. So at the moment, the SGC is non-deductible, so all of that is being reviewed. And the payday super change does contemplate a new digital tool to integrate ATO records with employer software. So I know a lot of organisations have had some challenges with the stapled super fund changes that were introduced a couple of years ago. This should also be alleviated under this new software. Now, on my next slide, I've got an extract from the ATO's website. It's a snapshot of the ATO's compliance activity and some interesting stats for the 2022 financial year. I thought that this was really, it would be useful to share with everyone because it really does highlight the ATO's big focus on superannuation. Some of the key stats that I wanted to draw to your attention are that we are seeing there are around 20,000 individual complaints made in the 2022 financial year. The ATO took pride in the fact that all complaints were reviewed. Of this amount, there were around 75% of that led to compliance activity. So the ATO takes very seriously any employee complaints when it comes to potential superannuation non-compliance. Some other stats on the slide, what we can see is that the ATO's audit activity consisted of a combination of employee complaints and also the ATO's own initiated cases, and that came from STP data that was used to identify non-compliance and earlier engagement with employers. So I suspect we'll see this type of snapshot each financial year. This was recently handed down, as I mentioned, for the 2022 year. Moving on to the next slide. Again, it's another superannuation update, but this one is a decision. It's the JMC Proprietary Limited against Commissioner of Taxation decision, which considered whether a lecturer, Mr. Harrison, should be classified as an employee or an independent contractor. Now, the court considered the superannuation obligations of JMC at both common law and under the extended definition of an employee under the SG legislation. So the full federal court determined that Mr. Harrison was not an employee, neither at common law nor under subsection 12.3 of the SG legislation. Now that subsection relates to those employees or individuals who are deemed an employee by virtue of the contract between the parties being principally for labour. So that provision did not apply per the full federal court. The Commissioner of Taxation did apply for special leave to appeal. However, this was rejected by the Commissioner of Taxation. Now, the key takeaway from this decision was that the common law assessment was based on the terms of the written contract. So what the court did was uphold the principles that were set in those two High Court decisions that were handed down last year, JAMSEC and personnel contracting. And in those cases, as you might be familiar with, what the High Court held was that it was the written terms of the contract that are paramount, and that is the basis for which that employee versus contractor distinction should be conducted. The reason for the court's decision in this case was that Mr. Harrison had the ability to subcontract or delegate. He had a high degree of contractual control and a high degree of autonomy. Now, moving on to the next change, include the Closing Loopholes Bill. So this was a bill that was introduced a number of months ago, and it proposes to introduce into the Fair Work Act 2009 an interpretive principle for the definition of an employee. So if it's passed in its current form, what the provision will do is require that the written contract, together with the substance and practical reality of the relationship, require consideration when assessing if someone is an employee. And at the moment, the bill is currently before the Senate Education and Employment Legislation Commission, and we are expecting a report early next year. Now, if we move on to the next slide, and my next update is around the portable long service leave regime. So this, for those of you who are familiar with the portable long service leave regime, what it allows is employees to accrue long service leave entitlements and transfer them from job to job. So each jurisdiction has their own unique legislation. In most jurisdictions, this scheme commenced applying to the building and construction sector. However, a number of years ago, we started to see some jurisdictions introduce the scheme to community services. So at the moment, the Victorian, ACT and Queensland legislation also contains provisions in relation to community services. That being said, we are aware that a number of other jurisdictions are exploring the expansion of their current scheme to community services as well. So I wanted to spend a couple of minutes talking about the Victorian scheme, because this one has led to quite a few questions across the industry here in Victoria, because there were some interesting changes a couple of years ago. So to begin with, the scheme commenced from 1 July 2019, and at the same time, interim regulations were introduced, which basically set a predominance test. So it's looking at those employees who are involved in the personal delivery of community services, and where they met certain requirements, then they were considered an eligible worker under the scheme in Victoria. However, these interim regulations were replaced on the 1st of October 2020, and these current regulations, as they're still applying, they clarified certain terms. So they removed the predominance test, and instead the provisions have much broader application, because it now looks at award coverage, and where you've got employees covered by certain awards, then the expectation is those workers will be eligible for registration under the scheme. So if we move on to the next slide, I've set out those awards that are stipulated in the regulations. The first one is the SHADS award. So I know a lot of employers and community services are governed by the SHADS award, and then you've got the other 4 awards that I've set out. So what does that mean if these awards apply? It means that you will most likely have an obligation to register all of your workers who are bound by, or who have entitlements under those awards, for the portable long service leave scheme. So where an individual is considered an eligible worker, an employer is required to register the employee under the scheme, they're required to submit quarterly returns, and they're required to pay a levy. It's currently 1.65% in Victoria, each quarter on an employee's ordinary wages. So given this is an area that has had quite a significant change over the past couple of years, I do encourage you to have a look at your current registration if you are required to be registered under the regime, and to determine which workers you have registered. If you determine that you should have, in fact, registered a broader population of employees, then there will be a need to engage with your authority. So that wraps up my update, I'll hand over to you, Anthony. Thank you.
Excellent. That was great, Stefanie. And it was interesting with the portable long service leave, an issue from an accounting point of view that was coming up more this year, because it is now a few years that it's been operating in Queensland, similar to Victoria. So the amounts that are expected to be recovered under that when staff take long service leave are starting to become more material. So what we were seeing in the financial reports, and you'll see on our website guidance around accounting for portable long service leave and what you expect to recover, but potentially there should be an asset recognised there for the amount that you expect to recover. I think a number of organisations are actually netting it against the liability. So through our audits this year, there were a number of adjustments to break out the asset from the liability. But that's something that I think will, obviously those numbers will get larger as time goes on, and people will need to start to pay more attention to that. And I think in our experience too, employers are generally quite conservative when considering who should be covered. I know between the different states, the legislation's a bit different, but our experience in Queensland when it was implemented, a lot of not-for-profits did get legal advice, but ended up providing pretty much for all their staff. They saw that they fitted within that community services definition. So it is interesting, but no, that was a great update. Thanks for that, Stefanie. Okay, Russell, I'll hand over to you now to talk about new tax reporting requirements that are coming up.
Thanks, Anthony. And I don't have any particular slides here, so we're just going to run through a couple of just a very brief update here. And this relates to the big change that's coming is for those not-for-profits that are classified as non-charities but are self-assessing themselves to be income tax exempt. So for this year that we're in now, this current financial year, there will be a reporting requirement that starts next year. The format that the tax office has chosen to take is that each year the commissioner lodges a notice that requires various categories of entities to lodge income tax returns. So the Tax Admin Act provides that capacity, and for all of us as individuals, the rules are set out in that notice that we're required to lodge tax returns. And so that in next year's notice, that is when he does it for companies and trusts and super funds, etc., there will be a new category which will be for the self-assessing not-for-profits under that is determining themselves to be income tax exempt under Division 50. So, and that tax return will be on a, well, it's not a tax return as such, but that document that is required to be lodged will be both straightforward and complex. Straightforward in terms of the information. It's not going to require details of what the natural income is, because most entities may not have completed their financial statements and audits where they're June based by the lodgement date, which is 31 October. So it'll be just as individuals that don't have a tax agent, they're all required to lodge tax returns by 31 October. So too will be the date for these. What is uncertain still is to the extent to which these not-for-profits can access the tax agent deferral systems. So the data will just ask for an estimate of the income for the year ended 30 June 2024, and some other questions that will be focused on the manner in which the entity is organised. And this is where this is relevant for all charities, all not-for-profits, because no matter which category you fit in, the tax law is identical, and that is that it requires that the entity must at all times comply with the substantive provisions of its governing documents. So what are the key rules within generally the Constitution? And that it must apply all assets and all income solely to the purpose of the organisation. So it's important that each entity does that annual question of itself to say, are we doing this? Can we sign off? Because without meeting those two tests, no charity retains its income tax exemption. So similarly, the entities, when they're required to complete this form, will need to be able to attest that they have met these key rules, is the expectation on what will be on the questions. So that is something that each not-for-profit should be turning their mind to, is just understanding what are our substantive provisions in our Constitution, so that we can put our hand on our heart and say, yes, we have met them all. And there's a good ruling that the ATO put out on it, where it talks about examples and simple things like an entity that is focused on delivering care for women extends its care to men. Now, the Constitution in that example given focused on women, and so therefore by including men, that meant that they were not complying with the substantive provisions of their document. So it's important to ensure that the organisation is not suffering from mission creep, that as time moves on, that you just do a few things and suddenly you find you're doing a bit more than what the Constitution catered for. You've crossed a border, you've changed a field of service, looking at other ways you can deliver. So it's important to undertake that the board does that review and looks at that. So, and then you'll be able to satisfy yourself that that you can sign off those two requirements. And that applies equally to all charities, that everyone needs to do those exact same comparisons. What are the substantive requirements in our Constitution? And can we put hand on heart and say that 100% of our assets and 100% of our income is being applied to the purpose? So it'll be a good discussion next year. The ATO is collecting the list of entities that they're expecting based on ABNs and the like, and so expect that they'll have a bit of an idea of who's going to be on the list by the time this starts next year. Thanks, Anthony.
Excellent, Russell. That's fantastic. So, and I think you made, as we were preparing for this, you made the comment that even though charities don't necessarily have to comply with this, or are not expected to report, that it's still relevant to them. So,
they operate under the same rules of Division 50 for the income tax exemption. Yeah, and you know, we can expect, the ACNC is quite clear that they're going to focus more on reviews and compliance as time goes forward, become more and more the regulator that they're charged with the responsibility for. So we'll see them asking questions about PBI registrations, about charity status for charities, and doing those periodic reviews for that DGR status going forward. So it pays to be ready.
Yeah, I agree. And in my experience, I think a lot of not-for-profits do tend to not look at their constitution that regularly and go back to purpose and just see how it does exactly marry up, that it's still consistent with what they said 10 years ago or more sometimes. So I think it's a really good point.
Being able to have it to hand is a really good start.
It is, that's right. Okay, that's excellent. Thanks, Russell. I'll welcome Fahim to the call now. I'll just wait for his camera to start up. Fantastic. Okay, Fahim, so Russell's generously left you 7 minutes to talk about data, and I know that that's nowhere near enough, but I'll hand over to you now if you like.
That's plenty. Thanks, Anthony. Thanks, everyone, for hanging around to the last little bit. So data, there's a couple of things I wanted to just give you an update on in terms of what's happening. Obviously, we'll finish off with generative AI or ChatGPT and how that's taking over the world and all the hype and all the LinkedIn posts and social media posts that I'm sure you're all seeing. I'll just give you a bit of an introduction of how that's impacting things. But I just wanted to start off by talking about just your traditional focus areas, and a lot of technologies are being confused a little bit in the conversation at the moment. So automation of processes is still a big thing. So workflows, like in the finance space, like what you call coding of receipts and all those sorts of automated workflows, that's still a big thing. And a lot of companies that we are seeing and a lot of organizations we're working with are still focusing on that and trying to find time in their day to free up processes through digitization and automation. So that's still a thing. Then we've got data analytics. The focus on data analytics has somewhat shifted in the last couple of years, in particular, where a lot of people now understand that it's important, but they're now starting to go, okay, how do I do it a little bit more, like in terms of the platform I need to build so that I can have all my information readily available to you to make decisions. That's a pretty commonly understood concept nowadays. We've moved on from the days of, hey, why should I use data analytics? Most people have realized they need to have data from multiple systems in one place. So from your HR system, from your finance system, from your CRM, and all of that in one place so you can make a collective holistic decision. What's happening in that space a little bit more though is a few organizations have got that together, but the data is unreliable. So they're finding that the numbers aren't accurate or they're not matching up the way we expect them to. And it's not a technical issue, it's actually a business issue where people aren't putting the data in correctly and there's not enough governance around the data. So data governance and information management has become quite a big focus area for many organizations. Organizations have made big investments in data analytics, but they're finding that the data that's coming through is not as reliable as they'd like. So now the focus has gone to where's the governance around it, and getting people in the right frame of mind to say, hey, you know, when you enter the data here, make sure you're careful about what you put in because that gets relied on to make a decision at the executive level later down the track. So that's a pretty common thing. Data privacy and security kind of goes hand in hand with that as well. We'll all know about situations where we've had companies being hacked and attacked, and privacy information of your customers are leaked in the market. So that's become a big focus area as well. And then we're moving into generative AI, which is the new big thing that's on the horizon at the moment, and it has been for about 8 months, and it's moving at a rate of knots. So I just thought I'd spend my last 2-3 minutes just talking about it. AI is of two types traditionally. One is machine learning, which is predictive modeling and forecasting things. So Netflix is a good example of using machine learning. When they suggest what show you want to watch or what show you should be watching, they've used predictive modeling to work out that, hey, for him, if I show you this particular movie at 8 p.m. on a Saturday night, you're likely to watch that as a suggestion because you've watched all these other movies. That's machine learning AI. ChatGPT, which is the AI that everyone's talking about these days, or products like ChatGPT, is generative AI. And generative AI is all the craze at the moment. What generative AI is used for, there's 3 broad use cases. You can use it to create ideas or create lists of things. And if you're stuck thinking of ideas, I need a list of names for a new festival, it can just generate 10 names for you as an idea. It's really good for summarization and analysis. So if you feed it information, it can summarize it and spit it back out to you and say, here you go. Here's the key themes from what you've just given me and the information you've given me. And then the third one is it's really good for learning and exploration. So you can go through, you've got that idea of, let's say, 10 festival names. You can ask it, hey, what are the pros and cons of each festival name? And then so it can give you more detail so you can help choose something. So you can explore topics. I use it for like topics I don't understand. Tell me how, I don't know, something works. economic theory works or Keynesian economics works or something like that, and it can give it to you in example terms for you that are embarrassment-free zones. You don't have to ask a fellow human a dumb question. You can explore things together. And what we're finding is that what MIT has done some research to say that using this sort of technology in organizations is potentially going to save you about 40% of your time and improve the quality of your work by about 20%. So it's a really useful thing to start spending time on. There's risks associated with it as well. There's a lot to do with it. What we recommend is you bring the right leaders in your organization together to come and talk about how you can enhance what you're doing using these new technologies that are out there. So getting used to how it works, how does it impact us, and what else could we do with it is probably what I'll leave you with. There's a lot more on this topic, obviously, so please feel free to reach out. We can talk you through a lot more, but I'll hand over to Anthony.
Excellent, thanks for that, Fahim. And I'd imagine similar when you talked about this to a number of not-for-profit organisations last Thursday or Thursday 2 weeks ago, that there'd be a lot of people now listening to this that are getting ideas going through their head and generating interest. So, so really appreciate that. So we're actually up against our allotted time of 11:30. So I think, as I mentioned, hopefully you've been able to post questions as we go, and we'll certainly have a look at those and look to come back to yourselves on those. We won't, I don't think, have time now to actually go through any of those. I would like to thank our presenters today. They certainly do take the time to put the thought into it, to prepare for it and consider, well, what's relevant here for not-for-profit. So Aletta, Stefanie, Russell, and yourself, Fahim, know all of yourselves have a lot on, and certainly appreciate you taking the time and putting the effort in. I'd like to thank the participants that are listening this for taking the time out of your busy days to dial into this. Hopefully you did find it of interest. If you do have any questions with what we've raised here on certain topics and you would like to discuss that with someone, certainly feel free to reach out to ourselves, or feel free to reach out to your regular contact at BDO, and we can organise to have a discussion. All the best for the rest of your day, and thank you again for dialing in.